स्टार्टेड। देखिए सर एक बार आया था। एक्सीलेंट कनेक्शन होता है। पब्लिक है इसमें। हम्म, हो गया क्या? Sorry friends, due to some network issues, we are facing some problems today. However, we have already completed 8 questions. Now we are moving to the 9th question. The question is, selected percentage increase under escalation clause in fire which shall not exceed, the limit we have to tell, which shall not exceed 10%, B 25%, C 15%, D 30%. So we will give 5 seconds time, which will start now. The correct answer is 25%.
So this escalation clause for annual policies is allowed up to 25%, whereas in project insurance it is allowed up to 50%. And again, this escalation, whatever percentage client is selecting, it will be applicable on a pro rata basis for annual policies. Whereas in project insurance, escalation, whatever percentage he has selected up to 50% is applicable from the day one. That is the difference. In fire insurance and other annual policies, even engineering annual policies, it will be applicable on pro rata basis, subject to a maximum of 25%.
So friends, we are moving to 10th question. The 10th question is PML means. We have to tell the full form of this PML. A. Probable maximum loss. B. Probable minimum loss. C. Possible minimum loss. And D. Possible maximum loss. The time started now. The correct answer is probable maximum loss.
So in insurance context, PML is probable maximum loss. Normally it will be assessed by a risk engineer. Based on PML, insurance company decides its capacity.
Next question. AOG peril does not include. So what is not included in AOG? Option A, terrorism. B, earthquake. C, flood. D, inundation. The time started now. The correct answer is terrorism.
So it's a very simple question. Act of God peril. So terrorism is not act of God. It is act of human beings.
This
So
is
other than that, flood, EQ and inundation are act of God.
next. Under reinstatement value policy, following a claim, time allowed for reinstatement is. We have to tell what is that allowed time. A, 10 months. B, 12 months. C, 18 months. D, 24 months. Here are your 5 seconds. The correct answer is 12 months.
So in reinstatement value policy, normal time of reinstatement allowed as per policy condition is 12 months. But further, on request, insurance company can allow further 12 months.
We are seeing many people are giving correct answer, including Amit Kumar ji and Bhaskar sir, Naveen Sharma ji, Vijaya Vijayawar, Anika Patel and Bhavani Naidu ji. Keep on friends. We are moving to the next question, that is, in the event of a claim under fire policy, whether sum insured is reduced by the amount of claim or the sum insured is reduced by the amount intimated or the sum insured is not reduced at all, or D, none of the above. So you reply in this 5 seconds. The correct answer is sum insured is not reduced at all.
Unlike mediclaim policy, where after claiming an amount, the sum insured is getting reduced. Here in fire policy, the sum insured remains the same. So insured can make n number of claims within the policy period. But insurer normally will reduce the reinstatement premium to reinstate the sum insured after the claim. He normally reduces it from the claim amount. So as far as insured is concerned, sum insured is not reduced at all during the policy period, even if he makes a claim.
Some people are texting that screen is not visible, so there may be some issues with the quality of video streaming. So I request you all kindly give proper attention to the question when we are reading, then you will be able to understand what we are going to convey to you. The next question is, if computer are covered under a fire policy and in case breakdown of the computer due to short circuit, what will happen? So the option is the claim will be payable in full, or the claim will be payable as non-standard. C, the claim is not at all payable, or D, the claim is payable at the value of the computers at 40% depreciation per annum. Time starts now. The correct answer is the claim is not payable.
Here why the claim is not payable? Because computers are damaged due to short circuit. So that peril is not covered under fire policy. It can be covered either under EEI policy or any other all risk policy.
We are coming to the 15th question. Here it is. If a building is occupied in the ground floor as an engineering workshop and first floor as a dwelling by different owners, so the options are: first floor are rated at the higher rate for the 2, B, rated at lower rate for the 2, C, rated per se, or D, engineering workshop is rated at the rate of dwelling. The correct time starts now. The correct answer is it is rated per se.
Though both occupancies are on the same building, since it is a dwelling, it can be rated per se.
16th question. The minimum sum insured and retention of premium under floater declaration policy is A, 1 crore and 50% respectively, B, 1 crore and 80% respectively, C, 2 crore and 50% respectively, or D, 2 crore and 80% respectively. Time starts. The correct answer is rupees 2 crores and 80% respectively.
So here it is floater declaration policy. So minimum sum insured is 2 crore and maximum refund allowed is 20%, or in other words minimum retention is 80%, whereas in declaration policy minimum sum insured is 1 crore and minimum retention is 50%.
Now we are coming to the 17th question. The 17th question says, sequence followed under fire claims is what? A, depreciation, under insurance, excess, salvage, or B, under insurance, salvage, depreciation, excess, or C, under insurance, salvage, excess, depreciation, or D, depreciation, salvage, under insurance and excess. You have to tell the correct sequence of these terms that is followed under fire claims. The time starts now. The correct answer is depreciation, salvage, under insurance and excess.
Not only fire policy, for any property claims this sequence is followed. So you should remember the word RD cipher. So any claim processing will start with the reinstatement value, then you have to apply depreciation if it is market value settlement, If it is RIV settlement, depreciation will be 0. Then you have to apply salvage. If any expenses are incurred towards salvage, then that salvage will be modified as salvage minus expenses. Then comes the average clause or underinsurance, then excess. And finally, any reinstatement premium to be deducted for after the claim to be deducted. So that is why it is known as RDSAFER. In between one franchise is there, F, that is normally not applicable to fire claims.
Thanks, Sandeep sir. You are explaining it very well in the deep details of the fire claims. Now we are coming to the 18th question. That is, which of the following is irrelevant with regard to IAR policies? A. Fire LOP is compulsory. B. Declaration facility is allowed. C. MB-LOP policy cover is optional. D. Entire machinery excluding piping and cables needs to be covered. The time starts now. Declaration facility is allowed. This is not relevant to IAR policies.
So declaration facility is not there as per standard IAR policy, but nowadays different insurance companies are filing different add-on covers. So for some companies it may be there, but when the exam point of view, declaration facility is not there for IAR.
19th question. Which of the following is taken into consideration for arriving at the adequacy of sum insured under fire consequential loss insurance policy? A. Gross profit of the current policy. B. Previous financial year turnover. C. Standard turnover. Or D. Annual turnover. The time start now. Correct answer is annual turnover.
See, in FLOP, as you know, annual gross profit. So annual turnover will reflect the, or annual GP will reflect the correct sum insured. Annual turnover is the turnover for 12 months just prior to the date of loss, whereas standard turnover is the turnover corresponding to the previous financial year and which exactly tallies with the interruption period. And previous financial year turnover, you know, that is turnover of the previous financial year compared to the date of loss. So for under insurance purpose, we always compare the sum insured with the annual turnover. So annual GP will be compared with the sum insured in the policy. So that will give you the exact trend of the business, all other factors.
Now we are coming to question number 20. The question number 20 says, which of the following statement is incorrect in case of reinstatement value policies? A. Reinstatement of the affected property should be completed within 12 months from the date of loss. Or B. In case reinstatement not affected, then the claim can be settled. Option C. Value at the risk at the time loss will be taken to arrive the adequacy of sum insured. Or option D. It permits to settle the claim on market value basis. The time starts now. The correct answer is value at the risk at the time of loss will be taken to arrive the adequacy of sum insured.
This is the major difference between an RIV policy and market value policy. In the case of market value policy, adequacy of sum insured is seen as on date of loss, whereas in a reinstatement value policy, adequacy of sum insured is seen as on date of reinstatement. That means policy sum insured will be compared with the actual value of reinstatement as on date of reinstatement and not as on date of loss. This is because date of reinstatement will be at a much later date compared to the date of loss, probably 12 months or 24 months after. So sum insured should be adequate to take care of escalation in price.
We are moving to the question number 21. Fire at supplier's premises can be a part of A. Material damage fire policy, or an LOP policy, option C is a standalone policy, or the option D has no relevance. The clock started running. The correct answer is an LOP policy.
Supplier premises, customer premises, these are all extensions under LOP policy. We call it as contingent BI. As you know, in an LOP policy, the claim is admissible only when a material damage claim is admissible under SFSP or some material damage policy. So, in contingent BI cases, material damage proviso is not applicable. The damage need not be on our insured's premises. It can be on supplier premises, it can be on customer premises. So, it is an add-on cover under LOP.
The 22nd question is, common utilities outside the premises can be A. Rated per se, B. Rated as per the main risk, C. Highest rate to apply, or D. Insured separately. The time is started. Correct answer is rated per se.
Here common utilities, if it is within the premises, then it will be rated as per the main risk. If it is outside the premises, then you can rate it per se.
So those people who have seen the PPT prepared by Sandeep sir, which we have earlier uploaded on the channel, those people will be able to answer it perfectly. Others also can answer it perfectly if provisions. Yes. So now we are moving to question number 23. That is cold storage stock damage cover due to failure of public electricity supply under the fire policy, or is not an add-on cover under fire policy, or both are incorrect, or C or D both are correct. Time started. The correct answer is an add-on cover under the fire policy.
See, under fire policy, temperature is not covered. It is an exclusion. So, if you want to cover stock damage due to change of temperature, subsequent to damage to the cold storage machinery by fire and allied perils, then you have to take an add-on cover. In fact, there are two add-on covers, DOS A and DOS B. DOS A covers cold storage stock damage due to failure of public electric supply. So there should be a failure of electric supply by any fire and allied perils. And DOS B covers the same cold storage stock damage due to failure of the cold storage. So in DOS B, the peril is acting within the premises. In DOS A, peril is acting on the public electric supply.
The question number 24. Who can take the extension cover of loss of rent under fire policy? A. Tenant, B. Owner of the building, C. Both, or D. Cover is not available. You give answer the 5 seconds. Answer is owner of.
Basically an add-on cover or extension under fire policy. If the owner of the building has given the building for rent, and if the building is damaged by fire and allied perils, and he is losing not only the capital asset, he is losing the rent also. So that can be covered as an add-on. So it is obviously only owner can take it.
So the 25 question is, an insured takes a fire insurance for building and contents and a machinery background insurance policy for machineries. Suppose a short circuit is one of the switchboards results in a spark in the air conditioner, which results in fire damaging furnitures in the room apart of the air conditioner. There is a valid claim under fire policy only, or machinery breakdown policy only, or both the policies, or none of the policies. Reply in this 5 seconds. Yeah, answer is both the policies.
So here if you see, the air conditioner is damaged by short circuit and subsequent fires or setup has damaged furniture in the room. So all the other damages, subsequent damages to furniture and all, it is payable under fire policy. Air conditioner will be payable under MBD policy.
26th question. The principle of indemnity is applied in practice through A. Extra premium, B. Excess clause deduction, C. Franchise clause deduction, D. Deduction for depreciation. The time starts now. Answer is deduction for depreciation.
Depreciation is deducted from reinstatement value to arrive at the correct indemnity. So depreciation means an amount which is deducted for usage of the machinery or usage of the building. So correct answer is deduction for depreciation. Then only the indemnity will be pure indemnity. So fire policy is actually based on strict indemnity principle. So we will give the actual loss suffered by the insured. So when you attach RIV clause to fire policy, then it is a deviation from the strict indemnity principle. If you see fire policy, there are two instances where we vary from strict indemnity principle. First one is RIV, second one is contract price insurance clause. So once you attach RIV clause, we are not following that strict indemnity principle, we are allowing more than his loss. So if it is on market value policy, then we apply depreciation. In RIV policy, we won't apply depreciation.
So friends, this is the benefit of creating such a quiz with such an expert like Sandeep sir, because we are not getting the optional questions only, but also we are getting the complete knowledge of the concept which Sandeep sir is providing by adding all these things. Pawan sir also wants to say something.
Good evening, friends. Actually, we are facing some display issues. Maybe you are getting the screen blurred. So there are some network issues here. So just bear with us and just listen to the questions, Sandeep sir. So it will definitely help you, and in the next quiz we will definitely take into account these the technical glitches, and will try to improve. But I will request you all, if you are not able to see the screen, please listen to the questions which are uttered by Pranav, and the explanation and the answers given by Sandeep sir. I can guarantee that the explanation given is top class, and it will definitely increase your knowledge and will definitely improve you, definitely enhance your skill set for the exam purpose. So over to Pranav.
Now we are moving to question number 27. Annual turnover under fire CL policy is last financial year's turnover, B. average 3 years turnover, C. turnover from the date of interrupting year, or D. current year's turnover. The time starts now. The correct answer is turnover from the date of interruption to 12 months of the preceding year.
This explanation I had earlier given. Annual turnover under fire consequential loss policy or LOP policy is the turnover just prior to the date of interruption for 12 months. So this is taken for under insurance purpose.
Next question says, one of the peril not covered under the basic fire policy. What is this? A. damage by smoke and heat of the fire, B. damage caused deliberately or accidentally by fire brigades and in the discharge of their duties, C. damage to property removed from the burning building caused by exposure to weather, or D. destruction or damage to property insured by its own fermentation or spontaneous combustion. 5 seconds to go. Here is the correct answer. Destruction or damage to property insured by its own fermentation or spontaneous combustion.
Option A, B and C are actually covered under fire policy, though it is not specifically mentioned. It is part of the fire damage. When fire happens, smoke and heat are liberated, so those damages are also payable. And if damages caused deliberately or accidentally by the fire brigade during the fighting of fire, so that is also payable. And if the property is removed from the burning building and subsequently damaged by weather condition, maybe a rain or flood, so there the insured is not having the control. He was trying to minimize the loss, so those expenses or those damages are also payable under fire policy.
Question number 29. The insured does not cease to attach if trade or manufacturing activity is changed, insurable interest changes by will or by operation of law, C. remains unoccupied for more than 30 days, D. all of the above. The time starts now. Answer is insurable interest changes by will or by operation of law.
See, option A is condition number 3 in fire policy. If the trade or manufacturing activity is changed, then insured has to inform the insurance company, otherwise the policy will cease. Similarly, 30 days, then also insurance will cease. But if the insurable interest, if the insurable interest changes, then also there is no claim payable. But if the insurable interest changes by will or by operation of law, that means by a court award, then naturally the policy will continue. It should continue till the expiry.
Question number 30. If fire declaration policy was issued for a sum insured of rupees 1 crore at a premium of rupees 2000, the following declarations are received, maximum amount that can be refunded is. So we will give you the month wise declaration amount and you have to calculate what is the maximum amount that can be refunded. So in April the declared amount is 1 crore, May 0, June 0, July no declaration, August 0, September 0, October 0, November 50 lakhs, December 45 lakhs, January 55 lakhs, Feb 80 lakhs and March 40 lakhs 99,999. So now you have to calculate what is the maximum amount that can be refunded out of the premium of rupees 2000. Option A, rupees 1215 can be refunded. Option B, rupees 1381 can be refunded. Option C, rupees 1000 can be refunded. 400 can be refunded. The time starts now. The correct answer is 1000 rupees.
Friends, actually this is a numerical which can't be solved in 5 seconds or so, but we have deliberately included it, so please listen to the explanation and then revisit this question again because this video will be there on YouTube after this live stream also. So you revisit this question again, and now I will ask Sandeep sir to explain the answer. So you revisit it, but 5 seconds it's not possible. We have deliberately done it so that you can at your own leisure you can see it again.
See, as Pawan was telling, 5 seconds or 10 seconds or even 1 minute it may not be possible. But then see what you have to understand. First thing, you have to add all the declarations, 12 declarations, and divided by 12. That will be the average declared value. While doing so, you see in July there is no declaration, so you have to take the full sum insured as declared value. So you have to fill that July portion with 1 crore. Then you have to find the average for 12 months. Then you have to find what is the premium rate. Sum insured is 1 crore, premium is 2000. So what is the rate to be applied? Then that rate you have to apply on the 12 months average. Then you have to find out the new premium. Or premium you have collected already, and then what premium you have to charge. That is to be deducted from it to get the refund. But before doing all these things, you have to think of the logic. In any declaration policy, this is a simple declaration policy, not a floater declaration policy. So in fire declaration policy, the first guideline is you cannot refund more than 2000. So if you see the answer, more than two options are more than, sorry, you cannot refund more than 50% of the premium paid. So 50% of the premium paid is 1000 rupees. So if you see answer A and B ruled out, it is more than 1000, so you cannot give a refund for that. Then the answer is D. So then you have to apply the logic whether it will be 400 or 1000. So naturally from the declarations given, it is 1 crore, then again July 1 crore, then again November 50, for December 45, January 55, February 80. So majority of the declarations are more than the 50%. So naturally it will be 1000 rupees.
Question number 31. A plant is covered under SFSP policy and FLOP policy. A machinery was damaged in that plant due to breakdown, and the surrounding machines and stock were damaged due to the fire setup. A claim is admissible under which policy? A. Only SFSP, B. Only FLOP, C. FLOP and SFSP, and D. FLOP and SFSP excluding the machine which was damaged by breakdown. The time starts now. The correct answer is FLOP and SFSP excluding the machine which was damaged by the breakdown.
So here, though the cause of loss is a breakdown for a machinery, since there was fire, and because of fire other properties are also damaged, so claim is admissible for other properties under SFSP and the GP contribution of other properties or other machines towards FLOP. So if both the policies are there, then claim is admissible under both the policies. So claim is not payable for the particular machine which is damaged by breakdown under SFSP, and GP contribution of that machine will be deducted from the FLOP claim payable.
Question number 32. Turnover of a company in the previous year was 200 crores and it has been reduced to 100 crore in the current year due to a fire damage and consequent interruptions. The percentage of variable expenses last year is 60% and the percentage of variable expenses in the current year will be option A 15%, option B 60%, option C 30%, option D 120%. The time starts now. The correct answer is it will be 60%.
Here you have to understand variable expenses are expenses which are directly proportional to turnover. So if the turnover is reduced to 50%, naturally the quantum of variable expenses also will be reduced, but the percentage of variable expenses remains the same. If you take 60% of 200 crore, it will be 120 crore. So when the turnover is reduced to 100 crore, naturally only 60 crore of variable expenses or raw materials will be used. So as far as percentage is concerned, variable expenses percentage remains the same before loss and after loss.
So the difference is variable expenses and percentage of variable expenses. Variable expenses will vary as suggested by the name, but the percentage will never vary because it is a percentage, it will remain the same and expenses may change. Next question is, turnover of a company in the previous year was 200 crores and it has been reduced to 150 crores in the current year due to a fire damage and consequent interruption. The rate of gross profit is 30%. The amount payable under a LOP policy will be 50 crores, 100 crores or it will be 15 crores or 30 crores. The time starts now. The correct answer is 15 crores.
The sum insured for LOP policy is gross profit. So here we have to find out what is the loss of GP. So previous year it was 200 crore, it has been reduced to 150 crore. So there is a reduction in turnover of 50 crore, and rate of GP means GP by turnover, that is 30%. So that 30% we will apply on the reduction in turnover. So 50 crore is the reduction in turnover, into 30% will give you 15 crore. So 15 crore is the loss of GP.
Question number 34. An LOP policy is issued with 12 months indemnity period and accumulated stocks clause. The reduction in turnover due to a fire damage was made good by the sale of existing stock to the tune of 10 crores. Consequent to the depletion of existing stock, a reduction in turnover is reported during the succeeding year for rupees 15 crores. The amount payable as LOP claim will be arrived at by applying the rate of GP on 10 crores or 25 crores, or it will be 15 crores or nil. So you have to give in 5 seconds. The answer is 10 crores.
See, normally in LOP claim, the insurer asks for or asks the details of reduction in turnover. So in this case, if the insured is having stocks already in his godown, he would have maintained his turnover. So ultimately, before loss and after loss, there is no reduction in turnover. But during the indemnity period, if he is using the stock from the godown, that stocks will, a period of time, he will suffer the turnover loss. So in order to take care of that situation, there is a clause known as accumulated stock clause. So if the insured depletes the accumulated stock in his godown to maintain his turnover, then that depletion also is payable under LOP claim. So here if you see, he has utilized the stock to the tune of 10 crore. But during the next year or succeeding year, he suffered a loss of 15 crore. But that 15 crore insurance company is not liable. Our liability is restricted to corresponding GP of 10 crore. So GP ratio or rate of GP will be applied on the reduction in turnover up to a maximum of 10 crore.
Question number 35. Insured standing charges rupees 4 lakh. Uninsured standing charges rupees 1 lakh. Net loss is 1 lakh. And gross profit for the purpose of LOP policy is calculated as rupees 3,20,000, B rupees 3 lakh, C rupees 4,20,000, or D rupees 5 lakh. The 5 seconds starts now. The correct answer is rupees 3,20,000.
So this situation normally comes when the insured declares GP on addition basis. That means addition basis means GP is a sum of standing charges and net profit. So having an option to select the standing charges. So some people will do the selection. So then what will happen? He may not insure the whole or full standing. Insured may be making net loss also. So GP equation will be GP is equal to standing charges plus net profit, or if he is making net loss, standing charges minus net loss. Now since he is having a selection of standing charges, the equation should be modified as GP is equal to insured standing charges into net loss divided by total standing charges. So 4 lakh minus 4 lakh into 1 lakh divided by total 3.2 lakhs. So not the full amount of net loss will be deducted from the insured standing charges, only a rateable proportion of net loss will be deducted. So that proportion is net loss into insured standing charges divided by total standing charges.
Friends, Pawan here. See, this business interruption, the consequential losses is a very tricky sense that it has and various type of numericals can be asked. So deliberately, sir has kept these numericals so that it can help you in the exams. And the concept behind it, he is already explaining it. So please listen to it carefully, because usually as we move up in the cadre, that 2 to 3, 3 to 4, 4 to 5, so last, so 1 to 2 may get away with it, but not the higher cadres. So just listen to this, especially these numericals. As I earlier told you, don't go by the time 5 seconds. These are because we have to complete fast. So we have kept the uniform 5 seconds for each questions. But you can, as I earlier told you, you again listen to these questions, again listen to the explanation, so that it will help you in the exams. Over to Pranav.
Now we are moving to the question number 36. The question number 36 says, standard turnover was rupees 20 crores. Annual turnover was 100 crores. Rate of gross profit was 30%. Sum insured was 15 crores. So the turnover during interruption period was 10 crores. Now you have to, what will be the amount? Whether it will be 10 crores or 5 crores or 1.5 crores or it will be 20 crores. The time starts now. So the correct answer is 1.5 crores, option C.
So LOP claim is calculated by finding out loss of GP. So loss of GP is loss of turnover into rate of GP. Here loss of turnover is standard turnover minus turnover during interruption period. So 20 crore minus 10 crore, that is loss of turnover, into rate of GP. So 30%. So that will give you 3 crore. Now if you see, the sum insured is 15 crore, whereas annual turnover is 100 crore. So annual GP will be 100 crore into 30%, 30 crore. So 50% under insurance is applicable. So 3 crore into 50%. So 1.5 crore. So answer will be 1.5 crore.
The next question is, standard turnover was 20 crores. Trend in turnover was 10%. Rate of gross profit was 30%. And turnover during interruption period was 10 crores. Then LOP claim payable shall be rupees 3.6 crores or rupees 3 crores, C rupees 10 crores, or D rupees 20 crores. The 5 seconds starts now. The correct answer is rupees 3.6 crores.
So here you have to consider the trend also, trend of 10% also to be applied on the standard turnover. So standard turnover will become then minus turnover during interruption period. So that will give you 12 crore. Then multiply it with the 30% GP. So 12 crore into 30% will give you 3.6 crore.
Question number 38. An LOP policy is issued with departmental clause to a company manufacturing two different products A and B in two different departments. Loss of gross profit in department A is 1 crore, whereas gain in gross profit in department B is 1 crore, making the net loss of gross profit for the company due to fire accident as nil. Now LOP claim is admissible for an amount of A rupees 1 crore, B rupees 2 crores, C rupees 0.5 crores, or D nil. The time starts now. It will be for rupees 1 crore.
So as I was explaining the accumulated stock loss, here also initially we think that insured is not having any loss, because the loss in department A of 1 crore he has gained in department B. So ultimately net loss is 0. But since department clause is attached with the policy, that will help him. Insurer has to pay. If department clause is there, then the loss is to be seen department wise. So here loss in department A is 1 crore. So we have to admit the claim of 1 crore irrespective of the fact that other departments were gaining.
Next question is, the finished products in a factory was damaged in fire. The value of the items damaged as per the rates in latest sale invoice is rupees 1 crore. GP is worked out as 15% from the balance sheet. The amount payable under fire policy is rupees 100 lakhs, B rupees 85 lakhs, C rupees 115 lakhs, and D rupees 15 lakhs. Here comes the answer. It is rupees 80.
Policy profit element is not payable. So here it is the damaged item is finished goods. So naturally the sales invoice will show the sale price which is including the profit element. So we have to deduct the profit element, that is GP, from it. So 1 crore minus 15% will give you 85 lakhs.
A godown storing category 3 goods within the sugar mill compound to be insured under fire policy. The rate chargeable is A as per section 4 industrial manufacturing risk for sugar mill, B as per section 6 storage for category 3 goods, C as per section 3 simple risk, D as per section 5 utility within the compound. The time starts now. The correct answer is as per section 4.
We have to understand that in fire policy, one compound, one rate. So whatever materials are there in that compound, that should be charged as per the process rate. Industrial godown or utility, whatever inside the compound will be charged based on the manufacturing activity. Since it's a sugar mill, though it is category 3 goods, we have to charge as per section 4 industrial manufacturing risk.
Now we are going to question number 41. As per insured's claim, a windmill tower of steel was damaged due to fire spread. In order to ascertain that damage, which one of the following is preferred? A. X-ray test to ascertain cracks developed, B. Visual inspection, C. Microscopic examination to ascertain grain growth due to intense heat so developed, D. Report from OEM. The time starts now. The correct answer is microscopic examination to ascertain grain growth due to intense heat so developed.
This is a practical question. When a steel structure is damaged by fire, normally steel structure damaged by fire, we think that it is not possible. So as such, visually there won't be any problem except the smoke damage. But when you have this microscopic examination, then we find that have been changed. So the claim will be admissible based on microscopic examination of the steel structure.
Question number 42. Which one is a better risk? Property A. PML 10 crores, sum insured 100 crores, or property B. PML 15 crores and sum insured 50 crores. Option A is a better risk, B. Property B is a better risk, or C. Both are equal risk, or D. None of the above. So time starts now. The correct answer is A is a better risk.
Here better risk means as far as insurers are concerned. See, for insurer, even if the sum insured is same or sum insured is less, the PML matters. So here property A is having a PML of only 10 crore. PML is probable maximum loss. Whereas property B, though the sum insured is only 50 crore, PML is 15 crore. So in the event of a loss, the maximum loss that is estimated is 15 crore compared to 10 crore in property A. So naturally property A is a better risk.
Question number 43. A property worth rupees 100 lakhs was affected by flood and the loss is assessed to the tune of rupees 50 lakhs. The insured had taken all steps to minimize the loss and he saved property worth rupees 15 lakhs by spending rupees 20 lakhs. The claim amount payable is A. Rupees 50 lakhs, B. Rupees 65 lakhs, C. Rupees 70 lakhs, or D. Rupees 35 lakhs. The time starts now. The correct answer is rupees 65 lakhs.
So here the property damage is actually 50 lakhs, so that is payable. Apart from that, the client has or insured has spent some expenses towards minimization of loss. So those loss minimization expenses are payable up to a limit of loss thereby saved, which is known as economic limit. Here he has spent 20 lakhs, but he saved only 15 lakhs. So insurance company's liability towards loss minimization expenses will be 15 lakhs, though he has spent 20 lakhs. So we have to pay the property damage of 50 lakhs plus loss minimization expenses up to the loss thereby avoided. So that is 15 lakhs. So 50 plus 15, that is 65.
Question number 44. Under EAR or CAR policy, the installment of premium facility is allowed only if period is more than, so we have to tell the period, 10 months, or it is 6 months, whether it is 9 months or 12 months. The time starts now. The correct answer is 12 months.
So installment facility is not there in most of the policies, but in EAR and car policy, that is project insurance, this facility is given because the project policy can run into many years. No, it is not an annual policy. So installment facility is allowed only when the period is more than 12 months and the maximum interval allowed is 3 months and last installment to be collected 6 months before the expiry of the policy. And then first installment should be 5% extra compared to the other installments. So these are the rules applicable for installments.
6 more questions to go. Now question number 45. The last premium under EAR or CAR policy where installment facility has been granted has to be made before 3 months or before 6 months or before 9 months or 8 months. The time started. We got the right answer, that is 6 months.
So this I have already answered in the previous question. It should be collected 6 months before the expiry of the policy.
Question number 46. In MCE policy for 18 months, if the project is completed prior to declared date of completion, whether a refund of premium can be given or no refund of premium can be allowed, or refund of premium can be given if there is no claim. Option D, premium can be held as deposit for next project. So the time started now. The correct answer is refund of premium can be given if there is no claim.
So this facility is there in EAR, CAR and MCE policy. A refund of premium can be allowed if there is an early completion of the project, but then the minimum yearly completion period claim should be 3 months, and there should not be any claim reported.
Question number 47. There is some problem. Question number 47 says, which of the following statement is true? Statement A, deterioration of stock insurance is a form of consequential loss cover. Option A, statement B, claims under deterioration of under the concurrent machinery breakdown policy. Option A, neither. Option B, only A. Option C, only B. Or option D, both. The answer is also both.
Yeah. What happened that
Question number 48. In which of the following testing is an inbuilt cover? Option A, CAR policy. Option B, CECR policy. Option C, EAR policy. Option D, MBD policy. The time starts now. The correct answer is EAR policy.
erection all risk policy normally we issue when erection of plant and machinery is also involved along with the civil construction. Car policy is given when civil construction value is more than 50% of the project cost. So in an EAR policy, the majority of the value of project will be towards erection of plant and machinery. So erection of plant and machinery also requires a testing. So there is an inbuilt test cover for 1 month in EAR or SCE policy. Whereas a MBD is an annual policy, CECR is also an annual policy.
This is second last question. Which of the following statement is correct? Statement A, electronic equipment policy covers electrical or mechanical breakdown of the insured item. Or statement B, electronic equipment policy covers damage caused by the fluctuation of electricity supply voltage. Here are the options. A, neither. Neither of the statement is correct. B, only A. First statement is correct. Option C, only B. Or option D, both of the statements are correct. The time starts now. The correct answer is both of the statements are correct.
Electronic equipment policy is an all risk cover. It covers all types of damages, including electrical breakdown, mechanical breakdown, or electronic breakdown, or any damage caused by fluctuation of electricity, or any other period also, AUG period also. So it is an all risk policy. So answer is both.
The last question of this quiz. In MCE policy, during the time of policy period, if the works have not been completed, then there is A, scope of extension of policy, B, no scope of extension of policy, C, the policy is issued for an indefinite period, or D, none of the above. The correct answer is scope of extension of policy.
So any project, normally if it is delayed, it requires more time for completion than what is envisaged. So at that time, the insured may request for extension of policy. That facility is there in MCE policy, SCE policy, EAR or car policy. So on request of the insured, we used to extend the policy by charging an extra premium. So there is a differential rating for extension of policy, and policy period can be extended. Similarly, testing period also can be extended.
Friends, we are ending this quiz now, and I will take this opportunity to thank our beloved Sandeep sir, who has spared his valuable time from his office life, from his personal life, to be with us. And as you know, in the last promotion exercise, he was a topper in United India from scale 4 to 5, and now is currently the chief manager in the fire and engineering department. And so I hope everybody would have gained something out of this quiz, and we sincerely apologize on the behalf of GI Digest team, Pranav and me. We sincerely apologize the display issues which you all encountered during this live quiz. Our endeavor is always to give a good quality and a best material to all of us, and for that we sincerely strive hard. Day and night we spend so that you can get all the quality material. But yeah, today was not our day, so some technical glitches were there. But I definitely assure you that the quality of the material and the quality of the explanation which was given by Sandeep sir, and a lot of effort has gone into that, and that nobody can take away from us. And we will strive to be more, what to say, more, we will strive to improve further. And on this weekend, we are trying if we can get one motor quiz. So we will circulate the links, and we assure you that you will not suffer these hardships again. And again, because this video will be there on YouTube, so you can again revisit it. Even if the display issue is there, you just listen to it again and again, especially the BI and contingency part, because this type of numerical and this type of explanation, you need one mentor, you need one teacher to be your side and teach you, because all of us don't work in these departments. So most of them, very few of them will be working in this fire and engineering department, especially very few of them will have dealt with the this business contingency claims, interruptions claims. So it's always better that who has worked in and out, who has worked on daily basis, and is working on daily basis. So from hearing from his mouth is always beneficial to us. So I will sincerely thank again, sir. Thank you very much. And sir, if any tips you want to give to any, because you are a topper, so your words means a lot. So if any tips you want to give to our promotion exam aspirants, over to you, sir. Thank you.
There is no shortcut trip. You have to read the tariff 1 or 2 times, and the portion which we have not covered in this quiz or even in that PPT we have uploaded is that new policies, PSUS, BLUS and Grihareksha. You have uploaded separately, yeah, right. I am talking about my PPT. So Grihareksha, BSUS and BLUS also you can expect some questions from that. And normally the ratio will be 70% fire and 30% engineering, and out of 70% you can so that will be the ratio. Don't worry, you can score good marks, and engineering will be very easy questions as we have seen till now, but no assurance can be given, but at least you should go through the tariff once, then you can go through the PPTs and other materials. So thank you again, best of luck, God bless you.
Thanks, Sandeep sir. And